Hello everyone, welcome to the Fundamental Analysis tutorial series for Forex traders. Today we are going to discuss another topic, so let's get started. Okay, when there is a recession, how we predict a recession? How do we know that we are in a recession? So today we are going to talk about this. So let's first of all define what recession is. Recession is a synonym of contraction in business cycle in which overall economic activity declines significantly. And broadly speaking, a recession is popularly defined as two consecutive quarters of negative GDP growth. So when we have consecutively two negative GDP growth quarters, we determine that this is a period of recession. So what happens, what triggers recession? We have four indicators. For example, number one, aggregate demand drops due to low consumer spending and decreasing manufacturing growth, employment and income. There's a squared GDP down by 10%, which is the main indicator. And then if the recession is prolonged for 3 to 4 years, it is also referred to as economic depression. So this is what triggers a recession. So how to predict recession? So there are four ways we can predict a recession. Number one, an inverted yield curve. Number two, decline in consumer confidence. Number three, sudden stock market decline. And number four, rising unemployment. So let's look at each of them in more detail. An inverted yield curve, what it is. The yield curve is a graph that plots the market value or the yield of a range of US government bonds. So remember, this relates to US government bonds. And the term of these bonds is from 4 months to 30 years. When the economy is functioning normally, yields should be higher on longer term bonds. But when long-term yields are lower than short-term yields, it shows that investors are worried about a recession. And this phenomenon is known as a yield curve inversion, and it has predicted past recessions as well. So number two, we have decline in consumer confidence. So what happens when there is low consumer confidence? Consumer spending is the main driver of the US economy. If surveys show a sustained drop in consumer confidence, it could be a sign of impending trouble for the economy. And when consumer confidence declines, that means people are telling survey takers that they don't feel confident spending money. If they follow through on their fears, lower spending slows down the economy. And also we have another yardstick, a drop in the leading economic index. It's monthly published by Conference Board. The LEI strives to predict future economic trends. It looks at factors like applications for unemployment insurance, new orders for manufacturing, and stock market performance. If the LEI declines, trouble may be brewing in the economy. So that's the number two factor that how we can predict recession, that there is a substantial decline in consumer confidence. So number three, sudden stock market decline. So what happens that a large sudden decline in stock markets could be a sign of an imminent recession. Since investors sell off parts and sometimes all of their holdings in anticipation of economic slowdown, so that could be one indicator of sudden stock market decline that we are going into a recession. So number four, rising unemployment. And we all know that it goes without saying that if people are losing their jobs, it's bad for the economy, it's bad for everything. And just a few months of steep job losses is a big warning that there is recession around the corner. And it doesn't matter if the NBER, the institute who predicts recession in USA, has officially declared recession or not. Different indicators and data is sufficient to assess the presence of a recession. And let's talk about briefly the length of a recession. As we said, the NBER tracks the average length of the US recession, and according to NBER data from 1945 till 2009, the average recession lasted 11 months, and from 1854 to 1919, the average recession lasted 21.6 months. Over the past 30 years, that the US has gone through 4 recessions. So this question comes into mind, are we in a recession? Or how do we know if we are in a recession? So what happens that everyone's life will be negatively affected. Losses of jobs and pay cuts are the foremost signs. Residential and commercial construction slows down. Commodity prices will begin to decline as stores have large inventories. This happens due to the low spending by the consumers. So these are all indications that you are in a recession. And from a statistics point of view, the manufacturing and services PMIs will decline, likely below 50, and additionally unemployment above 6% or higher. These are all the US related data that tell us that we are in a recession. And when US in a recession, then the whole world is in a recession. And in the US, jobless claim rise solidly above 300,000 and towards 400,000 or higher. So these are some of the indications or signs that we are in a recession. All right, guys, that's about it. I hope you like it. See you next time. Bye bye.